Welcome back, everybody, to today's Market Explained, a 4-star podcast. And today we have an interview podcast and video series. And our guest, Michael Reisner, doesn't really know this right now, but we're going to be putting out videos on TikTok, Instagram, LinkedIn. So thousands and thousands of people might see this. Michael, we also had one that went to 186,000 views in 36 hours. So you might become famous on TikTok. Michael Reisner, welcome to the 4-star Today's Market Explained podcast.
Thank you for having me, Brian. I appreciate it.
Excellent. And Michael's the president of CION, which is a alternatives investment firm. They do a joint venture with the Ares Group, and there's a bunch of different things they do. So we're going to hear about alternative investing today. And, we're in a really funky economy right now, Michael. Some people are saying that we're going to have a recession now. Some people say we're in it. Some people say it's going to be really bad, and the jury's out. What do you say?
I think that's right. The jury's out. These are some interesting times we're living in. Yeah. I do think if people keep saying it, at some point the self-fulfilling prophecy will be realized and we will be in a recession.
We'll talk it. We'll talk it.
But that being said, there's certainly a lot of indicators that would indicate that we're not yet in a recession, right? I mean, employment numbers, whether they're non-farm payrolls or the household survey, are still fairly strong. I don't know about your business, Ryan, but we have a tough time finding labor. We've had want ads out now for a couple of accountants. So the labor market is still tight. And, a lot of times with supply chains, we've seen this in our portfolios now with the supply chains being constrained. Some of our portfolio companies are now replenishing and over-ordering and spending a lot of money. So you don't usually see things like that in a recession. Recessions tend to be, it's when people have a fear factor. Am I going to lose my job? And if I'm going to lose my job, I'm going to cut back on spending. And then if I'm a business owner, if people cut back on spending, am I going to have the sales? So I got to cut back on wages. I don't think you're seeing that yet. No. That being said, obviously, the equity markets is certainly reflective of a recession. And obviously, we have to get inflation under control here. So you're right. The jury's out. It's 50-50, but there's certainly some turbulent and volatile times on the markets. No doubt about that.
Well, and then the old adage that the stock market is called 10 of the last 2 recessions. So markets always react, and it either happens or it doesn't, right?
That's right.
It didn't happen in 87, right? But we had a market reaction.
That's right.
So we'll see. Well, tell our listeners, Michael, about the CION Investment Group and all the varied things that you guys do. You have a really interesting organization.
Sure. So, CION Investments, the best way to think about us is a kind of an open architecture solutions provider where we manufacture and distribute what we think are unique alternative investment products for the retail customer. Traditionally, and you've heard this recently, democratize alternatives. That's now a recent buzzword. The average institution has about 20 to 30% allocated into alternative investments. And you can define that various ways. The best way to think of it is just something without a CUSIP, something that's less liquid, right? It could be something as esoteric as art or stamps. In our world, it's traditionally more real estate, private equity, things like that. All the big boys, the Apollos, Carlyle, Blackstone, Ares of the world, they've made millions for their investors based on these illiquid investments in private equity. And it's been very hard for the average retail investor to access these investments. You're starting to see that change now. I think some of the big institutional asset managers are realizing that, the retail investor is really the final frontier. Right. By that, I mean, they've raised money from the sovereign wealth funds, from the pension funds, from the endowments, from the insurance companies. They haven't yet really tapped in a big way the retail investor. There's obviously some regulations to navigate, there's structures to navigate, but why shouldn't the retail investor have the same access to the kind of investments that the quote rich guys have been accessing for years with a lot of success? So we do that. We tend to partner with our institutional asset managers, which we think is a very good model, right? So somebody like a Blackstone or an Ares, they may be great at real estate or credit, they're not necessarily great at everything. And also, again, if you follow the money, your public companies, they're looking at their margins, they're looking at what moves their stock price. What we do is we partner with these companies, we invest in the funds, we invest in the startup costs, we have skin in the game. So we're 100% aligned, not just with the investment managers and the performance, but we're really focused on the retail investor to make sure they get the best experience possible and they're not kind of lost in the shuffle with some of the big investment managers that are out there.
Interesting. So, and you talk about democratizing. Yeah, we've heard that it's a buzzword, right? But we bring big institutional investment type programs to a smaller investor. So what's the difference there, Michael? I mean, are we really bringing the same investments, or is it the same investments, but the costs are a little higher because we're dealing with more people? It's probably that, right? A little bit higher.
Listen, it's a little bit of both. There's going to be a trade-off if you want some liquidity. And most retail investors are not going to like a 7 to 10 year lockup, right? So there's going to be a trade-off there. There's definitely some more costs involved, some more friction in the system. All the intermediaries involved have to get paid a little bit. That being said, is there a way through structure to access the same type of investments, even if there's some headwinds that are going to hurt returns? And we think there are. And I think you're going to start seeing more and more of that. You're going to need some of the regulations to catch up. You're going to need some of the advisors to catch up. A lot of advisors that are my age and your age, we grew up with the 60-40 model. And alternatives were just some esoteric thing that were the purview of the institutions. And to try to make that more mainstream, to get that allocation up to maybe that 20%, is going to require a lot of education. What is it I'm invested in? What are the risks? What are the rewards? And again, they're not necessarily riskier, but they are going to be less liquid. And that needs to be accounted for and planned accordingly. If you have a sudden medical emergency, a sudden wedding you have to pay for, you can't necessarily access that capital because that capital is working. So there's a trade-off, and it comes down to education. But I think you talked about the buzzword, as it gets out there, there's going to be winners and losers. But I think we're probably in the second inning of getting the alternatives out to the retail investor.
Okay, so let's talk about one fund that you have that we're investors. For full disclosure, we have investors at 4-Star that are investors in the CION Diversified Credit Fund, and that's one of your offerings, Michael. How is that different? Let's say the bond investor doesn't like his bonds at 1% anymore. How does that differ, and how far out on the risk scale might it be? And then what's the advantage, right? Well, how much extra yield do we get from that?
Sure. So, to take a step back, we also manage a business development company, a BDC, called CION Investment Corporation. For those who may or may not know what that is, basically it's a sector-specific fund where by statute, 70% of your assets have to be focused on the U.S. middle market. And we can talk about the U.S. middle market. We can talk about private credit, how resilient that's been, how it's grown over the years. One of the reasons it's grown is because of performance. The problem is, if the old adage, if you're a hammer, everything looks like a nail. Right. If you have to do a certain sector, you're going to have groupthink and talk yourself into always doing that investment, even if there might be better relative value somewhere else. So while we at CION have direct lending capabilities here in the United States, we didn't have the capabilities to do direct lending, let's say, overseas, or have a high yield bond desk or a CLO expertise. So what we did is we partnered with Ares Management, and we kind of brought this concept to them and said, listen, how about instead of a sector-specific fund, we have a core holding fund where we allow you, the asset manager, to go across not only the globe, but the credit spectrum, and go wherever you see the best relative value at any given time. So obviously, I'm a big believer in the U.S. Middle market and private credit. But there are times right now you're seeing some broadly syndicated loans that are just been beaten up in the marketplace. That maybe now in our interval fund with Ares, they're tapping the brakes on direct lending and going after some broadly syndicated loans. Right now you talked about bonds. For a while bonds were out of favor. We're coming to the point now that we're with the yield curve rising, and you're starting to get paid now for high yield bonds. You get 8-9%, and in some of these companies are very creditworthy, and you don't have to, you can go out a little bit on duration. So you now give the portfolio managers the opportunity to go across the credit spectrum in a completely diversified way and allocate where they're seeing the current best relative value. It's never going to be a home run, because that's not what we're designed to do. We're set it, forget it, go to sleep at night type of product. But that's kind of the thesis behind it.
Okay. So now you mentioned high yield bonds. High yield bonds are more aggressive investment than like a treasury bond, right? So how would the diversified credit fund compare to the risks of a high yield bond portfolio?
Sure. So listen, again, it goes back to there's a time to be in high yield bonds, right? I'm not going to say now's the time or not. There's a time when those are priced to perfection. There's a time when it's a great buying opportunity. In a diversified portfolio, and I'm sure all your listeners know about the importance of diversification, there are times when we think it's a good investment. If the portfolio managers happen to be wrong, because we have something like 500-600 positions, and each position is quite small, we're very diversified, you're really not going to be hurt in a portfolio like that.
Okay.
And it's no different than giving a portfolio manager various mandates, but now you're giving them in one commingled fund where the PMs can kind of diversify across the credit spectrum.
So would the credits that are in that 300 to 500 different credits inside your fund, would they be similar quality, high yield quality, rather than like investment grade or AAA?
Yeah, so listen, I think most of the fund is probably, I think it's about 40-50% is going to be direct lending and private credit. And one of the benefits of private credit that your listeners may or may not know is because it's private, you don't necessarily get rated. You're not necessarily going to be investment grade, but the borrower doesn't have to go through the trouble of doing that. The borrower doesn't have to go to an investment bank, doesn't have to take a market risk. They're talking presumably to one lead agent, negotiating the documents, getting certainty. But yeah, you know what? The biggest companies in the world, traditionally, they will still go out, the investment grade companies, they will traditionally go out and get a bond offering, because that's going to be a little bit lower cost usually. Or they will go out to get a broadly syndicated loan. That's starting to change, however, right? Private credit is becoming a bigger and bigger marketplace as more assets run into the space, and more borrowers are kind of realizing the absolute benefits of just working with one lender or two lenders, not being whims to the market, not subject to the whims of the market.
So the high yield market, you'd have to do a whole bond offering, find buyers, do a roadshow, whatever you have to do. So this might be a little easier path. And then, bond lending or lending it from banks, can it take you about a year to get money out of a bank? I mean, it's a long process.
It could be a very long process, and bank can come back to you 60 to 90 days later and say, sorry, the rates have changed. Because some of the big investment banks, their business models have changed, right? They will, Morgan Stanley, they'll say they'll do a deal for you. They're not going to hold that paper. They're going to go out to their clients, their insurance companies, and so forth. And kind of like we're in a volatile market today, they might call up and say, hey, I know I said I would do this deal at 8%, but I'm seeing good 9% deals out there. So I can't do that deal at 8% anymore. And then Morgan Stanley has to go back to the borrower and say, just kidding, here's the new rate. So, private credit allows a lot more certainty to the borrower. They can get a deal done, which, even if it ends up being a little bit more expensive, at the end of the day, certainty is what they really want in a lot of instances.
So out of the diversified fund, there's lots of credits in there, and they're not all perfect, right? So there's got to have been some issues with some of them. So what percentage of the bonds or the credit, I'm not bonds, but credits in that fund have had an issue, whether it be a markdown or a bankruptcy? How big is that?
So I don't have the statistic right off the top of my head. It is very small. A lot of that information is public. One of the beauties of this fund, and we've talked about kind of democratizing alternatives. This fund is a public fund, which means we have audited financials that are out there for anyone, investors or non-investors, to scrutinize. We have a whole schedule of investments where everyone can see all of our investments. It's highly transparent. It's not like we're investing in other people's funds. But yeah, one of the reasons we chose to partner with Ares Management is, listen, they have a 25-year cycle-tested track record. That includes, the global financial crisis, .com, you name all the price over the years. And it's proven that what they've done differently is they've invested in the infrastructure to build out a direct lending pipeline. Again, direct lending, private credit, one of the downsides of it, not to sound hokey, is it's private, it's direct. You have to find the borrower, right? You can't just call Morgan Stanley and have them feed it to you. You need a whole team of originators out there to cover all the sponsors out there. And that's what makes Ares, in our view, one of the preeminent lenders in the space.
It really is. Well, that's great. It's a great program. So, Michael, we know the credit fund well, and thanks for your update on that. You do have a lot of other programs that you're involved in with Ares or without Ares. Let's talk a little bit about those.
Sure. So I mentioned the BDC that we have. It started out in collaboration with Apollo. So I mentioned how we do believe in partnership. Apollo still has a piece of our advisor. They're no longer a sub-advisor. But as we sit here today, our BDC, our business development company, I believe is the 13th largest traded BDC on the market. So we started out with the BDC. We have our interval fund with Ares, which is about $3.5 billion. We recently announced a joint venture with the Man Group, which is a large alternative investment manager based out of London. Specifically, the partnership is with their private markets group, and it's going to focus on a specific niche in real estate, and that niche being single family rentals. And we have various other conversations going on as we speak. I think you could probably expect to see us do something related to private equity in the next 6 to 12 months, because that's such a big space. Specifically, there's not very robust secondary market in private equity. If you think about markets as they evolve, secondary markets usually become bigger than the primary market. You have an IPO market, and then you obviously have a stock exchange where you could trade that. Real estate, bonds, there's yet to be a mature secondary market. We'll probably do something out there. We're having conversations with asset managers about bringing an infrastructure fund to retail investors. Perhaps other niche real estate products. There's student housing, certain net lease products. There's things like that out there. But I think that's what we're doing. And listen, it's an exciting time, not only for us because of the fact that it is a hot area, but I think, for retail investors, they're going to have opportunity to invest that they've never had before. Access to big global investment managers, billions and billions of assets under management that never had access to before. So it's exciting times.
It is, very much so. Well, good. So in general, Michael, tell us your view on why would the average investor consider funds like this? Like let's talk again about CION Ares Diversified Credit Fund. Couldn't they get by with just bonds and CDs and things like that?
Yeah, sure. Listen, I think, again, let's start with the wrapper, right? We're in an interval fund wrapper, which means liquidity is provided at intervals. And that interval in our case is 5%. I'm sorry, interval is quarterly, up to 5% of the outstanding shares of the fund. And what does that do? When you have a semi-liquid wrapper and the investment manager doesn't have to manage for a quote run on the bank, they can invest longer term. They can do a lot more illiquid investing. So I think, the wrapper is important. What you've seen in anything that a pure retail investor heretofore has been able to access is complete liquidity. And complete liquidity is not necessarily in the investor's best interest. Probably is not in the best interest, right? Or at least for a portion of the portfolio.
Yeah, for a long-term investor, right.
Yeah, for a long-term investor. I mean, you look what's going on now in the market, the public markets, the traded markets, certainly maybe earnings are going to start coming down and, the intrinsic value of a security may start coming down with earnings. But you also have the fear factor. And we started the program by talking about, self-fulfilling and are we in a recession? Are we in a recession? And you know this better than I for your clients, but people probably panicked and probably sell and let's get out. And you know what? The smart guys, the Warren Buffetts of the world, they're the ones that are buying when the retail investor is selling, and vice versa. If you have a structure that can protect the retail investor from themselves a little bit and take away some of the emotion from investing, which is important. I mean, you have to be emotional when you invest. And I think the products that we are talking about, whether it's the diversified credit funds which again, we think takes away a lot of the emotion. It gives a world-class institutional manager the ability to invest where they see fit, not a certain sector that they have to invest in. If you put money into bond funds, there may be times that you don't want to be in a bond fund, and you have to determine. You, the retail investor, have to determine whether you want to sell that fund. It takes away a lot of the pressure. But real estate, private equity, these other illiquid asset classes, all one has to do is just look back the last 30 or 40 years at the track record. They are liquid. They do require fairly long-term holds, but if done properly, if underwritten properly in the right wrapper with the right investment manager, where there's interests that are 100% aligned, they prove out to be a real portfolio stabilizer and portfolio diversifier.
Nice, interesting. So now we're in this volatile stock market, and we're in a volatile economy. Volatile, maybe volatile is described by going down, I guess. I don't know. Stock market.
Sure.
How does that affect the private investments? Do we see any change in our value in the meantime?
Sure. So
credit fund.
Yeah. So a couple of things. So in a way, volatility is good for us. Maybe not the reasons for the volatility. We can talk about that. And we talked a little bit about inflation and supply chains and labor shortages. But volatility now makes the alternatives look a little bit better, right? So, oh my God, now the alternatives aren't down 25% or 24% like the S&P.
Mm-hmm.
So it kind of puts private credit, it puts real estate kind of in the forefront of, wait a second, I never wanted to be in these asset classes because my stock portfolio, all it did was go up. Mm-hmm. Now all of a sudden, maybe it's not true. Maybe it doesn't always go up. Maybe I should take a look at these asset classes.
Right.
Causes of volatility, obviously, there are various. They tend to be, they don't have the mark to market with somebody selling. So obviously a private credit, if I was to lend money to the 4-star wealth advisors, your value is not going to change daily. It just will not change daily. Now, on a quarterly basis, when I look at your earnings, if your earnings adjust, maybe there's a mark to market on an illiquid basis. Because obviously, if a company that did $100 of revenue that's publicly traded is trading down, when I do my valuation analysis, I have to take in the macro environment into consideration. So even the best private company, our best borrower. So if I lent money to 4-star and you were paying religiously, and by the way, you could be having a great quarter. Your numbers could be up. I still may have to take a quarterly markdown, just the way the valuation process works. Again, that doesn't mean that it's a bad loan. It just means in the current environment, this is what the market values at. But you're going to see a lot less of that volatility. You're going to see a lot less of the daily moves. But on a quarterly basis, it will be down. And I think, our interval fund is down a few percent, not much. But the key thing, and we always talk about this, is, all right, my NAV is down, my value is down. Why is it down? Right? Is it down because you're taking losses? You mentioned before, bankruptcies, write-offs, companies not paying, or is it down mostly because of the mark-to-market volatility? And, in our situation, and a lot of the alternative investment managers now, most of the NAV hits they're taking is because of the mark-to-market. Now, that being said, if we do enter into a recession and things get worse, you could have losses. We haven't seen that yet. So if you look back at the first 6 months, alternatives have performed better.
Interesting. And certainly less drama.
Absolutely.
So, Michael, you guys are into also, you mentioned infrastructure funds, perhaps REITs. You say there's no offerings there, but they're coming, possibly?
Right. So we have a private REIT now that again, because it's private, we can't talk too much about. We are in various discussions with other asset managers about infrastructure, about real estate. But again, we want to do something that's differentiated. There's a lot of REITs out there. I'm sure you offer a lot of REITs to your clients. We want a REIT that's somewhat differentiated, unique in structure, maybe aligned with an asset manager that has a cycle-tested track record in a specific niche. Infrastructure, obviously, is, again, it's kind of a buzzword now, but we're in some conversations with some, again, large global asset managers that have a long history of doing that. So again, there's a whole spectrum of things we're looking to. We're not going to bring out products for product's sake. We don't want to be a supermarket. we want you, and next time one of my guys is in your office talking about our product, I want you to say, all right, well, it's a CION product. It must be a pretty good product. Let me listen to their story and let me listen to what they have to hear. Obviously, you're going to do your own diligence. We want people to do their diligence. But we're not just going to say, here's 30 products, which is, I think, the old model, the old equity model, right? When people come in and say, here are my 30 ETFs, pick the 3 or 4 that you like. Now let's go to lunch. No, we want to bring you 4, 5, 6 differentiated products that are really taking advantage of the secular tailwinds that we're experiencing and can bring kind of a unique experience to your clients.
So the patient investor can get some better returns if you're willing to put up with a little illiquidity and be patient about it. Maybe you can do better than public markets.
Yeah, and I think you got to be careful. Better returns is relative. We say, more stable returns, better Sharpe ratio, better risk-adjusted returns. So again, you're not going to back up the truck and do everything in that. But when you are building out a portfolio, looking to diversify and stabilize, these private market investments, these are liquid investments, absolutely produce great relative value returns.
Mm-hmm. So we talked about the areas you're in now. What other areas would you look to right now in this environment? We're in a really crazy, seems to be slowed down in the economy. Market's real volatile. What do you see here as an opportunity? There's got to be an opportunity out there.
Listen, there's always opportunities, right? I mean, quite frankly, it might be an opportunity in equities right now. We're not going to do that, but they've gotten down 25%. There's probably a little bit oversold there. Listen, I think we talked about the big sectors. I mean, real estate is a huge market. Obviously, there's big guys out there that are almost acting as a proxy for the real estate market in the United States or an index. We're looking to do some niche products. We talked about infrastructure. We talked about private credit. You might start seeing sector-specific private credit products. And by that, I mean focus on a healthcare or tech and things like that. But again, going to our model, we have 2 or 3 products right now. I think you'll see us have 5, 6 products over 4 or 5 years, and hopefully grow those products to the point that you're recommending them to your clients because they're best-in-class products.
Mm-hmm. Have you done any looking at gold and Bitcoin, things like that?
You know what? People have brought us some Bitcoin ideas. I don't know. I'm a little bit of a dinosaur. I own some, but I don't understand what I own. I don't really understand that well. So I'm not going to say no. I'm not going to rule it out. We talked about Warren Buffett before. He doesn't invest in companies he doesn't understand. It's going to be hard for me to call you up 2 years from now and say I got the best crypto fund out there if I have a difficult time explaining it. But listen, It's certainly possible. Certainly possible. Okay. But again, when I think of true alternatives, crypto, it's right on my desk, right on my screen on CNBC here. I can see what it's priced at daily. Right. I'm not sure that's a true alternative the way I think of true alternative. That's something that's, not readily available, not readily marked, not volatile, not subject to the whims of the consumer and retail investor who might panic sell.
Well, it's interesting today after a dreadful beginning to the year with Bitcoin down 50%, it's up 7% today. So I don't know what that means. But you and I both have a little more money.
I wish I knew. I don't
Absolutely understand Bitcoin any better than you do, but we'll see. We'll see what happens with that, right?
Right. Yep.
Well, good. Well, this broadcast will be seen by hundreds of investors, many of our clients, and many of our advisors that are out there that follow the 4-Star Network. And is there any message that you'd like to send to everybody? And seeing as you're in the auditorium and there's 300 to 500 people and 1,000 people over the next 6 months will see this, what would you like to tell all these great folks?
Well, so I think from a macro perspective, we're certainly in some uncertain times, as you said. I don't think it's a foregone conclusion we're in a recession. But again, I think what a recession is, it's when people are fearful, when people are panicking. And that's presumably the time to invest. You're going to see some good prices. It's oftentimes not about what you buy, but the price you buy it at. So I think for all your investors out there, whether it's a CION product or another product, I think they would do themselves a service to understand what alternatives are, what they could do for your portfolio or their portfolio in terms of diversification, stabilizing, even potentially enhancing the returns, because I think they're here to stay. And I think it's incumbent on me, you, and all our colleagues to just educate these people about alternatives, because it is a growing piece of the pie. And if the endowments are doing 25% of it, then why shouldn't you and I have 25%?
Yeah, sure. Sounds like a great idea. And now we have a chance to do that with programs that have lower minimums and more access where we didn't have that before.
Well, that's right. It goes back to the creative structure, people like us that are bringing the education and explanation and the transparency and walking through what's going on. And more competition is going to continue to bring the fees down and should inure to the benefit of the returns. So I think it's an exciting time for our industry.
Sounds good. Well, thank you. We'll look forward to checking in with you again, and we'll see where we are in 6 months to a year as we come through this crazy environment. But the word crisis also means opportunity in certain languages, and so we'll look for those opportunities. And thanks for being with us.
Absolutely. Thank you, Brian. I appreciate the time and look forward to seeing you in person soon.
Well, great. Well, thanks. And for all the great folks at 4-Star, Chris Reardon, Laura Swanson, our whole team in Chicago and the East Coast, and all the advisors, we'll sign off for another episode here. Thank you again, Michael, for being with us today on today's Market Explained, a 4-Star podcast.
Great. Thank you so much.
Thank you. Goodbye, everybody.